Lots of scary stuff in the news. Interest rates are on the rise. Is a recession around the corner? What are housing prices going to do? I got more data for you to look at coming up next. Hey, what's going on, friends? I know there's still plenty of scary stuff in the news about what the economy is going to do, what interest rates are doing, what the housing market is going to do. And as you know, I love to go back and look at the data and point to what's happened in the past does not necessarily mean what's going to happen in the future, or sometimes looking at trends from the past tell us more about the future than what we immediately remember in our short history. And so I wanted to show you a few slides here, a few graphs that show the big difference. And I've talked about this in the past, right? The biggest difference probably between the crash in the housing market the last time and the economy that we are in today is lending standards. And so this graph shows you that the lending standards in the early 2000s are nothing like the lending standards today. And we've talked about this in the past, but the amount of product risk versus borrower risk in the market is significantly different, right? You see all this red up here. Lenders were taking a lot more risk in the early 2000s and lending money to people who were not as well qualified. And that put a lot more risk in the financial markets as opposed to on the borrower. And if you look at even in today's market, as we got out of the recession and the housing crash in the late 2000s, the borrower risk is still lower than it was back then. So the borrower risk is lower, and there's virtually zero product risk in terms of the risk on the lender side of it, because they've been a lot more careful. There's been a lot of federal reforms in terms of lending standards, and that's changed the market significantly. And so that borrower risk just doesn't exist like it used to in the early 2000s. And this one better illustrates that. So on this graph, what we're looking at is the volume of loans in billions with a credit score of less than 620, right? So that's a big indicator, is what is your credit score and your ability to pay back and how much risk you have when somebody lends you money. And if you look at this, I mean, we were up in the $350 to $400 billion range in terms of the number of loans that were given to people with a credit score of less than 620. And that fell significantly in the late 2000s and then has hovered around 100 million and even less all the way up until this point. So that has not changed, right? That's stabilized, and that's been very steady going forward, is the amount of people who get loans. It's a lot harder to get a loan if you have a credit score of less than 620. And so the lending standards are much, much tighter than they were in the last crash. So even though we may be going into a recession, it doesn't necessarily mean that there's going to be a housing crash, because these underlying risks and standards are different than they were in the early 2000s. And then this graph shows you forbearance. So we've been here talking about, and I've did some videos about in the past about the end of forbearance and what does that mean. And this is an important track of where the number of people who are in forbearance, right? The number of loans that are in forbearance, how many are there, right? Because that kind of tells you how many people are in danger of losing their homes or in danger of foreclosure, because that was a major issue back in the last crash, was that there were so many people underwater and in trouble that it collapsed the housing market because that number was so high. But if you look at this is just going from May of 2020, right? So the height, right after the economy shut down, the height of COVID, when these forbearance programs went into effect, there was almost 5 million loans that were in active forbearance, right? They weren't paying their mortgage. They were having trouble. The banks were giving them relief from paying their mortgage. And that number has steadily fallen since then. And then we can see that going down. And it's still falling, even in today's market where we're at. Well, we're down, below 1 million loans that are in forbearance. And so this is normal territory that in the lending market, people that are having trouble paying their mortgage, we're back into normal territory. It's green, right? So this is a good indicator that there isn't like this huge rush of foreclosures potentially that are going to happen, and people that are behind on paying their mortgage are not paying their mortgage. And so you don't have that same situation where there's all that risk of people just wholesale stop paying their loans, and you have this huge crisis in the financial industry. So another good indicator that the housing market is healthy, even if we do go into a recession. And I'll show you here, this is a very important thing to understand, is there has been recessions about every 10 years in the country. That's kind of a normal thing that we go through in our economy. But really the only time where a recession and a housing crash happened at the same time or happened at all was in the 2006, 2007 housing crash, right? These are home price appreciation numbers since World War II. So starting in 1945, there's been steady appreciation in the value of homes. And then, of course, there was the spike in 2006, 7, and there was the crash. But it's continually steady and gotten back. So if you're in it for a long hold, values always come back. And in 2001, we're here. So things may top off and kind of smooth out for a little while because interest rates are getting higher, and if we go into a recession, that will cool the economy down. But these were recessions, right? This is where the housing market kind of creeps up, and then it didn't fall. It just kind of topped off, and then it kept going up, and then it topped off for a little bit, and then kept going up. And this rise, it probably should have stopped around here and then topped off a little bit. But that's what I think is going to happen here going forward. Is beyond this point here is we may see a topping off like we did back in the 60s, 70s, 80s when those recessions happened. Because again, when we go back to the lending standards, the stuff that caused this big spike right here in 2006 has been fixed in our economy. The lending standards have been fixed, they've been tightened up, and we're not in a similar situation that we were back then with the risk in the borrower market and the mortgage market like we were. So just interesting data to look at. I always like to point back and never mind what the news is saying or what your friend across the street says or what your uncle says. Look at the data, make an educated decision on, how you want to handle your finances and make your purchases or non-purchases or sales going forward. But, I can tell you that the data is not showing that we're in a similar type situation as we were in 2006. So as we've been saying for a while, if you're waiting for the crash and, a bunch of cheap homes to come on the market, it's probably not going to happen. We're just going to see either flat or lower appreciation. We're not going to see 20% year over year appreciation like we've been seeing. We may go back down to normal 3, 4, 5, 6, 7, 8% type appreciation levels, which is totally normal for the US economy. So if you have any questions or you want to book a meeting to talk about your real estate plans or just have a consultation, there's a link in the description below to my calendar, and you can book a link there, or you can always email me at Dylan@BuyBigIsland, and we'll get back to you. Thanks for watching. Aloha.